You're buying a laptop or a car, and the cashier asks, "Would you like the extended warranty?" Most answer in 10 seconds. Making that choice on the spot can mean paying twice for the exact same protection. You might buy coverage that overlaps with what you already have, or later discover the specific repair you need is completely excluded. The logic sounds solid. You hand over a bit of cash right now to avoid a massive, painful bill down the road. For certain items and certain budgets, that upfront trade-off makes perfect sense. But the word warranty is doing a lot of heavy lifting here. In many cases, you are not extending the original warranty at all. You are buying a separate service contract, governed by a different company with its own deductibles and rigid rules. The manufacturer's warranty comes included. It's a promise to fix specific defects for a set time or mileage limit at no extra cost. Over on the right is the extended warranty. This optional, extra-cost service contract is frequently sold by a third party, not the manufacturer. That distinction completely changes how your repairs get handled. A third-party contract may require you to use a different repair network, might cover fewer parts, and the effective start date can be highly misleading. If you assume you are getting factory-level protection just because the salesperson used the word warranty, you are taking a financial risk. You have to judge the product you're actually buying. Imagine sitting in the dealership office after a long day of buying an SUV. The finance manager shows you a $2,400 service contract, pointing out how expensive modern cars are to fix. Notice the green factory warranty covering the first 3 years, while the paid plan starts on day 1. This creates a massive overlap. If the service contract runs at the exact same time, you are paying for protection you already possess. You cannot evaluate a plan based on the sales pitch. If you don't calculate the specific start and end dates in the contract, you could hand over thousands of dollars without adding a single day of new protection. The real product you are buying is never the vague promise of peace of mind. The product is the specific written list of covered failures and the exact out-of-pocket costs required to fix them. The Federal Trade Commission advises checking for several specific hidden costs. Look for deductibles per claim, shipping charges, and transfer fees. Vehicle plans routinely exclude wear and tear and skip accident damage entirely. For an appliance, the contract might exclude failures caused by improper installation or power surges. If a specific part isn't explicitly listed in the paperwork, the plan won't cover it. The safest rule is simple. If a repair or a cause is not clearly written down as covered, you must assume it is excluded and that the bill will fall entirely on you. When a claim gets denied, it isn't automatically proof of a spam. Frequently, the failure truly falls outside the strict legal bounds of the service contract. For vehicles, contract administrators regularly demand proof that the car was properly maintained. If you cannot produce receipts for oil changes and tire rotations or required inspections, your claim can be denied on the spot. You also cannot just tell a mechanic to start working simply because they say the repair is needed. You have to contact the warranty administrator first and get formal pre-approval. The paperwork might require you to use a very specific repair facility, undergo a formal inspection, or follow a drawn-out diagnostic process before they agree to pay a dime. The time to figure out the claim process is before you pay. If you wait until your car is actually broken down in a shop to read the maintenance rules, you risk paying a hefty premium only to have your claim rejected. Before buying a retail protection plan for a laptop or appliance, pull up your current credit card's Guide to Benefits. Many cards already offer purchase protection or an extended warranty feature. This coverage isn't universal. It is tied to strict eligibility rules, limits on how long the protection lasts, and exclusions for used items or specific product categories. To actually use those benefits, the issuer will require you to provide the original purchase receipt and a copy of the manufacturer's warranty. Moving back to the dealership, you might face pressure to add a service contract to get approved for a loan. The Consumer Financial Protection Bureau clearly states these contracts are generally optional and not legally required for financing. Be incredibly cautious of mailers or unsolicited phone calls claiming your warranty is about to expire. The FTC warns that these telemarketers are almost never connected to your manufacturer or your local dealer. The risk here is real. In June 2026, the FTC announced over 9,000 refund checks linked to American Vehicle Protection, following a case regarding deceptive telemarketing and false claims about costly bumper-to-bumper coverage. Because these contracts are completely optional, giving in to high-pressure sales tactics usually leads to a financial loss. If a seller tells you a plan is required, ask them to show you that exact requirement in writing. So, with all these rules and exclusions, are extended warranties ever actually worth the money? This diagram shows the core trade-off. On one side, you have the expected mathematical cost, which includes the contract price and deductibles. On the other side, you have the risk of the covered repair and the emotional benefit of knowing a sudden bill won't disrupt your budget. A plan can make sense if the item has notoriously high repair costs, the deductible is manageable, the coverage explicitly begins exactly when your factory warranty ends, and a surprise bill would cause severe financial distress. But if the product is highly reliable, the plan overlaps with your existing coverage, the exclusions are broad, or you could simply hold that premium in an emergency savings account, skipping the contract is the better choice. Consumer Reports noted in past member surveys that car owners typically paid more for these contracts than they received back in direct repair benefits. The seller's pitch is designed to close a deal, not to protect your wallet. You have to calculate the odds and run a personal cost-benefit analysis. Otherwise, you will likely pay more than you ever get back. Before you sign your name on any extended warranty or service contract, run through this final 3-step checklist. Step 1. Check what you already have. Read the original manufacturer warranty, look at the retailer's return policy, and check your credit card benefits to root out any overlapping coverage. Step 2. Price the real risk. Write down the total contract price, the deductibles, and the claim limits. Compare that total against the exact amount you could safely stash in an emergency fund instead. Step 3. Read the denial section. Ignore the bold marketing headlines and focus entirely on the exclusions, the required maintenance network rules, and the exact cancellation terms. The goal isn't to reject every single plan. The goal is to trade your money only when the protection is real and legally enforceable. Next, watch our guide on the hidden costs of owning a car in America, because the monthly payment is rarely the whole story.